to just check out our the YouTube channel.
Yeah. What's the episode?
Yo. I think we're online, yeah. Check out our the YouTube channel.
Yeah. What's the episode?
Sweet. Right, let's do this.
Just want to set this up. So.
Yeah, man, you carry on.
Online, yeah.
I'm gonna have to turn that off, aren't I?
Online now.
It is. Can you press it? Ah, sweet, it's working. Cool. Right, so hi guys, thank you very much for coming to watch this video. It's going to be quite relaxed. We're going to have a go at valuing. Who are we valuing today?
We're going to be valuing Pernix Therapeutics Holdings today. So it's a biotech company situated in the States. So yeah, we'll see.
So this is going to be very interesting because valuing this type of company is very, very difficult. We're going to give it an attempt, so bear with us. Again, like I said in the description, we are not necessarily professionals at this, but we do this for fun. So join in with us. See if you want the model afterwards. Just let me know and I'll put it in the link for you. Where are you live? Yeah, on Facebook. We cannot show you the screen. So if you want to look at the screen, go to YouTube. So basically we're going to be doing this now, and I'll be building a model based on debt equity ratios, profitability, revenue growth, revenue forecasts, and all sorts of other stuff. And then maybe we'll see how much time we've got. We'll start diving into what kind of products they've got, and then into like what kind of products they've got coming out, what kind of products are in sort of testing at the moment, what kind of products are in what stage of testing, that kind of thing. But we're going to try and keep it simple and do our best to value this company. Should we do it?
Yes, let's
Cool
go.
beans. Right. So the basic kind of model valuation that me and Scott tend to use is just a very, very simple sort of revenue forecast. Check out the last few years, check out what revenue growth has been, and then we'd look at profitability, the earnings per share, what the earnings per share growth has been. We then look at the profit year on year, revenue year on year, all sorts of stuff, and then we'll start to look at asset balance sheets, income statements further in detail, and just sort of see what we can do. And then by the end of it, we can start to think about how we can actually generally come out with a share price. We can look at down here industry averages. So for this company that we valued last week, a couple of weeks ago, we found out the industry average price to earnings ratio was 30 times EBITDA, and we actually valued the company at about just under a penny a share, so 0.79 penny GBX per share. So if you check out that company online right now, you'll see it's trading at basically that. So we're not going to look at the share price, even though Scott probably knows it because he's very, very interested in this company. So we're not going to look at the share price now until finished, and we'll see what we can do. Now, with these types of companies, the difficulty is sometimes is to actually be able to sort of get a true valuation, because a lot of these companies are valued based on their pipeline. So what numbers come out of this business now are probably going to seem to you guys as a bit like, oh my god, what the hell. So we're going to need to look at their pipeline and look at what kind of the other pharma companies in their sort of
industry
position are trading at in terms of EBITDA, and then we can sort of come up with a decent valuation number and see what we can do. So yeah, follow along. I'm going to bring up this model now. We're going to use the income statements. I'm going to copy this over pretty much. I'm going to blank out the.
Sorry, Josh. Can you just check if I'm live on that?
Yeah, sure, man. Give me 1 sec. You're not. It says stop live video. You're all good. Right, let's dive into it. So we use the SEC Gov to basically find out everything that we need to find out. You can go there, it's pretty sweet. You can just search PTX and it'll find out everything that we need to find. Ooh, go live. So, right, all this is very nice stuff. It's all the documents you need to look for: 10Ks, 8Ks, 10Ks. Oh, hi Facebook. You can, if you want to watch the screen on Facebook, people, go to YouTube. That's much, much easier for you.
Also, if you have, why is it stopped again?
Just leave it. Let's just leave that.
Just get
Facebook,
a
you're not nice compared to YouTube. Right. Just takes a few minutes to sort of settle this up, and we can get going. going to get rid of all this. Alright, Scott. Can we get some? Can you bring up the? Let's bring up the 2013 numbers for PTX right now.
Sure.
And then we can. So ideally, we'll work on this on a yearly basis because we can go down to quarters, but you're looking at it'll take a long time. So we'll just go back. We'll just do the 10Ks for now, and then if we want to dive any further, we can. So let's try and find that 10K for 2013. Usually comes out early 20. When's the year end?
31st
of
March.
Where's the 10K on this then?
It's
It's on the next page.
yeah.
Annual report, there we go. This might be 2012. Blah blah. Yeah, this is 2012 fiscal year. So actually it's going to be. So we're looking at 18th of March 2014. That should have been there. Oh, they filed late in 2013 then.
Controversy.
Because that ain't there, motherfucker. Let's have a look on here if we can see if we can find that 10K. Where is 2013's 10K? There we go. See that one? That's 2015. Where the hell's 2013 10K? There it is. We're a bit blind. Perfect.
Annual report.
So this is, for those of you who haven't seen this before, the document we're looking at now is the annual report. So 10K means the annual report basically. So it'll have all their financials, and we're going to look at this is basically where we're going to be looking and finding everything that we need. So let's have a look down here now. Go find some income statement, shall we? I'm going to bring these up side by side so I can. Where are you? Net revenues. It's just consolidated right now. Statement of operations and income statement. Cool.
Okay.
Is this in millions or is this in thousands or is it millions? In thousands.
It's in thousands.
84,000. Okay. So we can see here that was 84,000. Expenses, COGS, cost of sales,
43,870.
870. It's the gross profit. What was? So they're bringing SG&A quite early on.
Also, Rocco Driscoll, if you're watching, thank you very, very much for getting in touch through LinkedIn. It's always great to see that people are interested in the subject and want to be engaged. So thank you very, very much for your question and your email yesterday, which I replied to about half an hour ago. So if you're watching, yeah, just stay tuned and we'll see what kind of things we can come up with. But very, very good to see that you're a shareholder. It's good to see that there's people out there that are, proactive in trying to learn more and develop more and see, what they can find. And as an investment situation, it's always great to see collaboration in the community itself, because, this isn't just a one-person thing. This isn't just an individual effort. It's about a collaborative team effort to try and make as much money as we can. So, yeah, great stuff, Rocco.
So basically, what I'm doing here, I had to mess around with this model a little bit because the way the balance sheet set out, income statement set out, was a bit different to what our previous model was. So they didn't have any loss from the PP&E, 19,680. Damn, son, these people lost money in this year. They lost quite a lot of money. Wow. So why isn't that was working? That's why. So there was a sum. I'm just having to mess around with the sum of that through that. Bang. Wow, minus 54,700. Right, we are up and coming. Let's go. Right, I'm just going to switch you back onto the screen now so you can see this shit rolling. So you can see that in 2013 they actually lost $54 million.
That's a lot of money.
But their R&D budget was actually only $4.8 million. They lost a lot from personal property, equipment, and that kind of stuff. So basically, I'm guessing that they were spending a lot of money on just getting everything ready to.
Yeah, more focused on the products more than.
But less R&D budget. That's interesting. So we'll have a look at this. We should just plug these numbers in, and then we can stick out, see what's happening for the rest of the year. So that's income. I'm just going to put that as other income because I'm going to have to mess around with the formulas here, people, so bear with me because it's a bit different to the way the other stuff's laid out. Administrative expenses, income tax expense. I'm going to get rid of that one. This is actually quite annoying. This one needs to go there. Why is it send me that shit, though? So their operating loss at this point is actually $46,391,000, which is very interesting. Income tax expense. Let's have a look. Income tax expenses. Income tax expenses were quite heavy. So their income tax, wow, fair enough. And then this is, sorry, I'm having to play around with these formulas at the moment. Taxation. Right, so they're coming up here with how many shares outstanding we got out here. Right, so basically we got an end of year number here for 2013, a loss of $25 million a share, and $25 million in total, and a loss of $0.7 a share.
Yeah.
What are we trading at? Oh, I can't look at the share price.
No.
I'm not allowed to look at the share price. Right, should we do balance sheet now, or do you reckon we should just wait?
Should we do the balance sheet?
Just slam through it because otherwise I'm going to win. Cash and cash equivalents was 15,647. Trade in the receivables. Did they have any trade in the receivables? No.
Nope.
Loans and borrowings, current liabilities, debt. But where? Total assets, cash and cash equivalents. Where's the rest of the assets?
Scroll and see if there's another page for the balance sheet.
They put in goodwill on there. Where are they getting that from? So basically, this is a really small balance sheet. There must be
a very small balance sheet.
There we go.
Oh, there we go.
Sweet. Cash and cash receivables. Account receivables. I'm gonna completely change this up.
receivable.
I'm gonna spell things wrong. Get over it. Inventory.
Prepaid.
Notes receivable. Deferred income. And the total. Then we've got PP. And then the assets. We've got investments. I'll see what they're doing on their goodwill. So goodwill is brand, by the way. So that's what they try and value their brand at, which is always an interesting one to try and negotiate and debate about. Now, don't worry, people, that you're probably doing your nutting that I've spelled stuff wrong. I'm gonna change it now. Cool. And then let's have a look at liabilities then. Oh, what happened? So that, oh, there we go. Liabilities. So accounts payable. So accounts payable is like, what do you think accounts payable is, Scott?
Accounts payable is stuff that they are owed.
No, it's what they owe.
In the next
accounts receivable is what they're owed. Accounts payable is like,
what
so they're creditors and debtors. Well, I already did that one. Accrued allowance is that one. Who was the previous CEO?
What's the guy's name?
Put options.
Douglas Drysdale, who did a terrible job.
Adrose. Douglas Drysdale did his terrible job.
Yeah. As you can see from the income statement.
Yeah, I mean, yeah, we need to see what we're saying on that. So let's have a look. Long-term liabilities, we've got put options, contingent to consideration, other liabilities. I'm trying to get back into us quickly while they do that. Whilst I change my debt, long-term debt, and then deferred income taxes. Oh, that's a big old balance sheet. We spoke too soon. They're getting into detail. I think it's interesting to see the US balance sheets compared to the UK balance sheets, because the UK balance sheets are often less detailed, as we've seen, because we did this on a UK company last time, and it was nowhere near as detailed. Let's plug some numbers in here then. Right. So let's have a look. I'm just going to quickly do the formula so that we can see things as they. Does it give total assets there?
Yeah.
I need to put something in there very below. Just total. Oh, why did I do that? So it's that. No, it's that plus sum of that. Cool. Cash. Let me just do this one. Sorry, quickly. I'm having to do all this again, so bear with me. This is good if you guys want to check this out and build your own models. You can see what I'm doing. Right, cash. We've got 15.646 million. 15,646,963. Oh, why do they switch between thousands and millions? That's frustrating.
How annoying.
For fuck's sake. I'm going to do it in thousands.
Yeah. So 15,646.
15,646.963. And then we've got what in terms of accounts receivable? 25.6. 25,681. 681 point. Oh shit. 0.371. 1389. 929. 4749. 1318. That's it. 70. So we're missing something then. 4,709. Ah, we missed one.
Prepaid income taxes.
Prepaid expenses was actually 5878. 5878. 0.292. What have we missed there then? Note receivables, which is actually 4749.418. Deferred income, prepaid income taxes, that's what we missed. So actually that one is the 1,318.4. How is that possible? Are we missing something here? 15.
Cash,
25,
accounts receivable.
13.
Inventory.
5, 4, 1, 3.
No, that's the full set of current assets. Is it property and equipment?
No, that comes
No.
after. I don't know what they've done there, but we'll move on. 6872. Zero good. Well, let's have a look at the goodwill then. 42,496,000.
It's a modest number.
496 point what? 492. 80 million, 22,000. The receivables, 4.531. Another long-term assets, 1. So we're currently missing $6 million somewhere, and I don't know where it is. Because you've got 1, 2, 3, 4, 5, 6, 7 numbers there. You've got 1, 2, 3, 4, 5, 6, 7 numbers there, and they're all the same fucking numbers. So 1, 2, 3.
That's odd.
That is very odd. Anyway, ooh, don't spill your coffee, mate. Right, accounts payable 343.629 3833.27. Options. What are we saying? Put options 1.33. Other liabilities
14,387.
No, it's 933. And then there's that short term debt is 16,999. 687. So total. Yeah, some product yield. Okay, so that one's right. Long-term liabilities. Bold. Other long-term liabilities are
14,387.
yeah, 14,387.
Long-term debt 1,309.
Yep.
And deferred income taxes 15,499.
15,499. $100 million of liabilities. So the debt to equity ratio. It's interesting, isn't it? Wrong one. It's 2.
Yep.
Oh, equity to debt ratio, sorry.
Debt to equity.
Debt to equity. Interesting.
So you would class that.
So that's equity to debt ratio, to be honest. So. I'd say that's good. But then it's actually, so just quickly looking at that, that's like understanding like what, trying to understand what it actually is that making those assets be. So account receivable of 25 million, that's pretty decent because that's actual cash that they're owed.
Yeah.
So it's whether or not they'll pay that. They've got $15 million of cash. So even with those two, that's a decent $40 million asset class. They've got inventory of 13 million. Notes receivable again 4 million. Deferred income of 9 million. Plant protective income of 6 million. Goodwills and the intangible assets is the one that you've got to worry about. So you're looking at about $84 million of assets that are genuine assets, and then you look at goodwill and intangible as ones that you can really.
Yeah, I mean it's harder to value the intangible assets because it's hard.
You can't really value.
You can't put a price on brand value.
All right, so that's 2013 done. Let's have a look at 2014 now. This has become a lot quicker now, by the way. I'm just gonna go on there. I'm just going to bring this across so that all models are in place. Again, scroll down using this. We tend to not. You can read all of this, but it'll take you a long ass time.
And actually, we're doing this in really good timing as well because obviously PTX has its earnings on Monday, so we can easily slot the Q3 numbers in, and we can see the progress that they've actually made throughout the year.
Yeah. 45,156. 62,967, 62. R&D was 4798. Whoops, did that wrong. 45, 4516, 6297, and then it's 3938.
Yeah.
No loss from joint venture. I just sacked that one off anyway because it was 0. Loss from assets, impairments, intangibles. Why do they change it? Stupid.
Of the joint venture.
No, I'll leave the joint venture one.
No.
Nothing. Loss and settlement PML. Oh great, so they're sticking in more shit for us to add year on year. Thanks PTX. Oh, that's a brand they sold. Sorry PTX, I take it back.
We love you, really.
Yeah.
Just to let you know as well, guys, we are live on our Facebook page, Avalanche Enterprise, so get in so we can harness some of your questions as well. Do you want to know more about the company? Do you want to know the current state? What you think will happen in the future? Leave some comments in the box and give us a like and a subscribe.
Absolutely. So we had a gross loss of 32,600. Oh, what have I done here? What the hell? So I'm just trying to find 665. I must took one out by accident. Yeah, so there's a loss of $36 million, which is better than last year. I'm just trying to find out where our formulas have gone wrong to get this, basically. So that's minus that.
Yeah.
So if we took that off, and we took that off, and then we did that as minus, then that needs to be...
How many views have got on Facebook?
You have on Facebook?
Yeah. I think. Oh no, we're not. It's just YouTube. Don't worry.
Nice. Man, we're getting really pissed off with this right now. I'm just gonna leave it as it is, and then we'll just have to say it. We know it. We know it anyway. Just that. Put that one as minus. Tell you what, stop making an effing loss, and then we might make our life a lot easier. Oh no, it was right. Sorry, guys. I'm being stupid. I am being stupid. There we go. Cool, we made a loss of $30 million this year, PTX. Well done. In 2014. Right, other income then. So we lost another 826. So we actually lost money then. Damn. 49. 11. By the way, we are literally looking at the balance sheet. This is the reason. This is the boring part, but it's really interesting to just look through and work it, and then we can start to see some crazy numbers in a bit.
Just a tip for investors starting out: if you're ever looking to value a company, the balance sheet is the most critical part of the whole
And the
jigsaw,
income
if you
statement,
like. Yeah, but balance sheet is what I would look at first. Just gives a picture of a company, the snapshot of a company in time. So very, very important, guys.
Make sure that's spelled right. Income tax expenses. Income loss before tax 49 million, yeah. Income tax expenses was 35 million. Cool. So cash receivables was 34. Wow, lots of cash this year. Oh,
I want.
Inventory was 11,360. Oh look, they changed to thousands. Thank you very much.
You.
Oh look, it added up this time. PP&E, what are you saying? PP&E.
1514.
0. Goodwill this year 449. It's interesting they're saying that their goodwill's only gone by 2 million. Intangible assets of 300 million. Now where the fuck did you get that from? Oh, I'm guessing that's probably pipeline, right?
You would think so.
Oh lord. Net receivables
Nothing.
0. Long-term assets 1125.
Wrong one.
$487 million. Nice. So this is the part you don't see about investing. This is like the not glamorous aspect to it. Actually having to put the hours in and really start to understand the company and how it's working and how good it's performing year on year, because you can't, it's super important.
For sure.
And it ain't glamorous. We're sat here staring at annual reports. No long-term debt in 2014.
It kicks in after.
Starts to go down from here. We can see convertible income taxes. They've added more stuff. PTX. If anyone doesn't know what senior convertible notes is, it's a bond. Isn't Trexmit? That comes into play a little bit down the line, doesn't it?
Yeah. Some litigation with GSK about their migraine drug, which they did prove to be successful. So yeah, interesting.
And deferred income taxes were 9,389. 200 and my fault. That should be 220,000. Cool. So we're still apparently positive in terms of debt to equity ratios of 1.2 now. So, but our debt to equity ratios, our equity to debt ratio is going down. So I'm guessing we're going to start using negative numbers soon, right?
Yeah.
We're going to get below 1. So you see, that was a little bit quicker. That only took us 10 minutes. So now we're going to hopefully get the next one done quite quicker than that. Let's find the next 10k.
Be that one. Yeah.
Oh, it starts to get all branded. They start to become a real company. It does make me laugh.
It's funny, but that John Seidel joined the board in 2015 as well. And suddenly the financials look a lot nicer.
They are increasing revenue. Let's just say that. They had a big ass year in.
So.
Loss from operational drug, which is still 0. I don't know why that's still there. Loss from PPE. Oh god. Loss from sale. I'm just going to put disposable assets. Just put asset loss from sale of assets in there, because why are you selling assets if you're making loss? Unless you need the cash, but you don't need the cash because you got cash, so what are you selling assets for? That's very interesting. Oh, you mother... This is more confusing. 94,695. people, it's really difficult to build these kind of things when they keep changing up their income statement every single year. Because,
and changing the way they present it as
the
well.
structure, because it's just like.
I prefer it when they release
And
their balance sheet.
debt restructuring costs, like that's now come in. Which is going to become a big player actually down the line.
Yeah.
I don't know. So we lost $101 million this year. So whilst the revenue growth year on year has been really decent, like it's still not. One second, let's find out what it is being. It's 0.3%. Actually, I did that wrong. Whoops.
It's time.
Mate, let's leave it. It's 30% growth. I'll work out in a minute.
B3 divides C4 times 100. B3 divides C3
That. Over that.
times 100.
So that, just bracket that and then times it by 100. Nice. That's wrong. Go. I really like mugs right now.
Yeah, I know.
Oh, well, that later on. I can't be asked right now. I forgot the model. I forgot the formula. 25. You work it out on your piece of paper over there. Right. So 2015. So last year we had a 0.93. Sorry, 0.93. This year we've got 2.78. So we actually lost $2.78 a share, and I reckon this is when they start to get towards their high, you know, because their share value is pretty high.
Yeah, but we're not looking at it yet.
No. Oh God, what have they done with this now? Cash, $56 million. They got rid of the investments page because they weren't making any. Not bad. Sorry. Credit facilities. 0. PTX, you've added more stuff for me to look at.
They don't make it easy, do they?
No. Debt short-term, other liabilities, we can count that as. There we go. That gives us a nice note. So apparently, I have no short-term debt though. Convertible notes, other liabilities. Oh my days, what are you doing to me?
I think the long-term ones are. No, don't know.
Nice. Debt, long-term debt. Mate, derivative liability, you fucking joking me? Sorry, this is starting to get really complicated now. I knew this was going to be really complicated.
It's 202.
I'm struggling with this. See where it falls into place. Convertible note long term, we've got that 103 million. They've then got the 194 million. 14,866. So that one doesn't need to be there. Yes! Tidy. Well, that was a pain in the ass.
We got there.
Look at that then. We're so very nearly
Yeah,
not worth anything.
it's bad. But what does 2016 say?
Oh, look now. So this is basically the equity to debt ratio falling down. Basically, we've seen revenue growth, but they're still getting worse and worse in terms of its loss. Like earnings per share, lost 70 cents a share, lost 93 cents a share, lost 2.78 a share. This ain't looking very good right now, is it? So they need to turn around, which is where Mr. Seedle comes in, right?
Sure.
So at this point, the company isn't worth anything. In reality, people, like it is, but not a lot. And a huge part of their, by the looks of it, a huge part of their income statement, sorry, their balance sheet is goodwill anyway. And intangible assets, which currently equates to about 100 shit tons, over $300 million of their balance sheet. So I'm not sure what you guys are thinking about now, but I need 5 seconds just to stop stretch. It really, it's actually to a lot of people, to a lot of outside people, this would just look like, oh, they're just copying the balance sheets and income statements over, but actually you're not, because we're currently looking at the growth and we're trying to understand what happened in the turnaround. But as we can see, they're complicating the hell out of their liabilities on the balance sheets for some stupid reason, and they've got all sorts of stuff, bonds outstanding now, which weren't there in 13. In 13 this was a very simple, a nice simple pharma company. Right now it's not. As we move into 2016, we've seen that they've got bonds outstanding on Trexmit, which we know is the GSK lawsuit.
Yeah.
There's almost $200 million of bonds on those, and then we've got 103 million bonds of something. I have no idea what the hell they are. And their short-term liabilities aren't too bad, to be honest. Their short-term to long-term liability ratio is decent.
Yeah.
Sorry, the short-term liability to the short-term assets is decent. Cool. Let's do 2016.
And now you could actually see that after the 2016 numbers are inputted here, that you'll see a bigger difference.
Absolutely. I'm just going to quickly, just give me 2 seconds. Talk to the camera, Scott. You need to tell the camera what happened with tell them what happened with Trexmit, and then we can quickly goodbye. Just have 2 seconds just to sort of look around.
Yeah, so while Josh does that, I'll just give you a little bit of a background on Trexmit. So with Trexmit, it was one of PTX's main portfolio drugs, and there was a bit of an issue with a company called GSK, GlaxoSmithKline. Huge company, worldwide company, billions of dollars in revenue each year, and there was a dispute over Trexmit. So there was a bit of an argument about the rights to sell it if they could produce a generic, which turned out that they couldn't. So that automatically makes Trexmit itself a lot more valuable drug to PTX. So it's great that the court ruled in favour of PTX. I think Cedar put a lot of investment and trust into all his lawyers and his team to make sure that that Trexmit remains a PTX drug and the generic can't be made, because obviously a lot of competition will sprout from that. And he's done a great job. That issue was settled about 6 months ago, and it did see a huge rebound in the stock price.
Mm-hmm. I'm just so you can see that the revenue growth's been so the profit year on year is actually depreciated. So the loss each year has increased by 27% from 51%, and then the revenues steadily increased at a 30% rate, which isn't too bad. But but their profit is dropping like no tomorrow, which means their outgoings and costs. So you can see here, I figured out the.
So this then becomes an issue of how can they scale back in terms of costs, not so much revenue, because we can see that the demand is there and it's growing, and as more resources are dedicated towards marketing the company, then that revenue is going to grow. But there should be a lot of emphasis on the cost that it actually takes or incurs to make that revenue.
Mm-hmm.
So we'll see what happens in 2016.
So 2016 would be posted. Were they late with their 10k in 2016?
They were. They pushed it back.
So this is the last one we can do, people, because this is what we got, and then we're just gonna sort of come around with where the bloody hell is the income statement?
Oh goodness me. Let's have a look. Quite interesting there if you scroll down, Josh, to where Cedar's options are. If you scroll down again, sorry. To there. So as you can see there on the screen, he's got 1,000 exercisable options at $47, and he also has 2,000 exercisable options at $37. So in the bigger picture, and when time comes past, and we're looking at the earnings report this week, and obviously before the settlement of the 8K for the 31st of July, it's very interesting to see that his options are striked at this price, because obviously I think John Cedo's got fantastic reputation for creating shareholder value, and if he's already priced in his options to strike at $37 and $47, then what does that say in terms of the final outcome of this company? There's a lot of bears on internet sites, and through articles, through SA, that have actually said this company's not worth that much. And it amazes me to see how many people have actually shorted this when they haven't even taken a very good look at the potential that this company holds. So just based on John Cedar's management and his experience and his history with other companies, then that should be taken as a bullish view.
That's why. So we'll just finish these numbers and we'll have a quick chat, because I don't think that the end share price is going to come out of this, because they aren't. I'm not sure what. Without looking into the products, it's not a very simple business at all, which we have now found. That's the income statement. Where's the income statement? Where are you, income statement? Oh my days, I'm getting really annoyed with this.
It's actually hurt my eyes.
What the
Look at the contents and see where it is.
Yeah, that's good. I should have done that before we started scrolling.
Yeah,
Right.
you go.
Just gotta bash this up. 856. 79. Oh God, what are they doing to me? They don't make your life easy. But now there's loads of new shit in here.
That's because of the debt, isn't it? Interest income. Sorry, loss on extinguishment of debt. Also some impacted by headwinds, currency.
Oh Lord. What the fuck? Gross profit. Where's all that in? They're playing around with my mind here. No, yeah, 42, 11, 622. Need that to minus. Whoops. Yay. Other income. Interest income, 0. Okay, so this bollocks here.
so technical,
This is
isn't it?
bonkers, mate. Why they're just doing it to piss me off. Oh god, okay. Yeah, other income then. Let's have a look. Other income. You know what, I'm just gonna add all up. Other income. Oh my days. Yay. Operating profit. 151. And then we have other income. Income tax expenses were
439. Which almost... still a bit off.
Tell me right now how this thinks. It needs to be a minus as well. There you go. Right.
It's all good, guys.
Ooh, minus 24% revenue growth this year.
Not great.
Right, cool. So that's very interesting. And then on the net equity balance sheet, where's that? Let's quickly just bash through this balance sheet, and then we can just gonna get rid of this side to make it all a bit easier on your eyes. Oh no, whatever. We're all good, mate. So cash. What the is restricted cash? Accounts receivable. Says it doesn't have any this year.
No restricted cash.
Prepaid income taxes. Their goodwill's shot down. Shut down. Zero. 310 million. 441,000. Boom. Thank you, PTX, for making your balance sheet nicer than your income statement.
Oh, we've got some live chat going on.
What does it say?
Shout out to Toby Bardsley. Shout out to Faizan Mohammed. And a shout out to Toby Larone. How you doing, guys? So Toby here says, would you recommend using Excel?
Microsoft Paint.
for
Shut up.
I'm not going to say what you are, okay? But less of that.
I like that. If you could use Paint to build me a spreadsheet, mate, you go for it. It's my it's definitely my brother.
Is it?
No, I have no idea, mate.
Oh,
Don't you just love this? You just love the sass.
the haters. You're a funny guy, Toby Larone. Funny guy.
Social secured net is long term 117 million. Senior convertible notes were contingent, didn't even long term 104. Why do you keep swapping this around? Why? Deferred income tax 0. Deferred income tax, long term arbitration award.
Yeah, so just to let you guys know, that arbitration award was a payment that was given to GSK. Sorry, guys. Given to GSK as part of their ongoing ongoing court case with GSK over Trexamit. So the deal was that they put half into a fund already, so they paid for half of it. Which does account to that 17.522 million you can see there, and the other 17 million odd is going to be paid over 3 years with very, very, very relaxed terms in the first year towards GSK. I think only $1 million is due this year, so again, speculation as to why that is so small, because if you was a big company, wouldn't you want the full amount straight away? What's hidden behind that $1 million payment this year? There's more to it than meets the eye.
So we're now worth not very much.
So we're under one now.
So that's very interesting. So we've seen, like, again, let's just, I think we should, we can start to go further into this. But the idea with this company is just, initially, was just to sort of look at what the last couple of years are saying. We know that there's a lot of stuff on the horizon for it. Its current market capitalization is very, very low, and based on its previous share price, it dropped so much. We thought it would be worth having a look at, and it's trying to turn itself around. We had huge EBITDA growth last quarter, didn't we?
47 million.
And
which was the first time this company's ever returned to positive EBITDA, so it's huge impact.
We're going to see some growth, I think, going into Q1 and Q2 of 2017. So I think that'd be very interesting to sort of see the model as we break that out, and then we can start to come up with the share prices and then start to do forecasts as we start to see some consistent growth. Right now, if you look at this balance sheet, the company's worth nothing, but then it's worth a turnaround basically. So if John Cedar can come in there, turn this thing around, and start to get some positive EBITDA growth over 3 or 4 quarters, we can then start to to forecast a little bit more, and then we can work out some share prices. But right now, previous to end of 2016, the company was worth nothing. We knew that. So with the EBITDA growth, it's worth something.
Yeah, for sure.
And the debt to equity ratio equity debt ratio is being hammered down, and there's been some really, really good awards with GSK, and they've got a lot of good products in the pipeline. So I'm positive it's a turnaround. I think that there's a solid foundation base that John Cedar has built here. Returning the company to positive EBITDA in the first time in years is a huge steps in terms of growing the company, dressing it up for a buyout, and obviously making it a lot more valuable on the balance sheet. But we look at the management style of John Cedar. You've seen that he's been involved in a number of different companies before, most notably spinning off CPEX to Bentley back in 2008, which returned a lot of value for its shareholders. So this is a guy that's done this before. This is a guy who knows his shit. This is a guy that's trusted on Wall Street, and I think analysts have covered PTX pretty well. So over the next couple of months, it is going to end. They have until the 31st of July. Otherwise, the creditors are calling in their loans. So there is a deadline, but I trust this guy. I think a lot of other
investors trust this guy based on his track record. He's got a fantastic record of creating shareholder value, and I don't see why he can't do it to this company.
Yeah, I think that if they can start to show some positive EBITDA growth for the next 4 or 5 quarters, then we can start to put some forecasts in place.
Absolutely. And what the balance sheet doesn't tell you either is that the potential of over-the-counter Silanor. So obviously Silanor is prescribed through doctors at the moment across America, but as that becomes the potential for an over-counter drug, it's going to be involved everywhere. So, we've seen what we've seen with Valiant before. We've covered that stock over the last year. They've had fantastic partnerships with Walgreens, distributing their drugs across the nation. And if Silanor can get that label for OTC, then it's going to be huge.
Absolutely. So yeah, I think if you've enjoyed that, obviously it's not, we didn't get it to a complete share price because we can't, because it's worth nothing on paper. So coming up with a share price, it wouldn't get there based on the last 4 years up to end of 2016. So without 2017's results and without diving down into core on core, which we're not going to do right now because it'll take us hours and hours, we can't derive a basic share price. So next weekend we will do something that's a little bit more simple, free cash flow basis, and actually work down a share price and actually do what we did with the Cannon Group, and we came out with the just under a penny share price. If you do check out that is actually trading at around there, so we hit that right on the nail. And we were pretty happy when we looked at the share price after we found out, and it was pretty much bang on. So
absolutely.
I hope you've enjoyed that. If you want this model, please just hit me up and let me know, and we'll give it to you. And you can use all the formulas below, because all the formulas down here for actually working out share price are all of the formulas down here that we used for working out share price still matter. But right now with what we've got here, we can't really do that, because again, looking at the equity to debt ratio, it's less than 1, which is not too bad, but the profit year on year has dropped again 57%. They lost $170 million in 2016. So as that grows, I'm confident we can start to see some better growth. So guys, thank you very much. I hope you've enjoyed that. It might have been a bit in depth, but not as in depth as we could have taken it. We could have gone way further.
Absolutely. And just on a final note, let's hear some comments. Let's get engaged. Get in touch with us. We want to hear from like-minded, business-driven, investment-driven people. So let's get those comments across and let's start some relationships. Good stuff.